This conference will now be recorded.
So this is the first session on the IFRS 9 regulations, model development and validation. Now, let me give you a brief background to this particular module and the core and the key expectations that you can have from this particular module. So over here, so all of you know that I have been hosting the credit risk modeling module over the last couple of years. First, with in collaboration with XLab Analytics, and now I'm doing it as a freelance basis. And as a freelance on a freelance account, I have kind of increased on the offerings that I can have at this point of time over and above credit risk modeling. So from the support that I have received from you all on in terms of the risk modeling module, I have been encouraged to kind of go ahead and offer a new kind of module, which which is selling like kind of the theme of which is selling like a hot cake in the market, and that is IFRS 9. So everyone is talking about IFRS 9, though the first phase of implementation of the regulations are over, but still this regulation is very much in demand because new acquisition of portfolios are happening over, through the banks, but the banks are acquiring up new markets, new portfolios, and they need to get them shipped up to the IFRS 9 standards. All portfolios are still not 100% compliant with the IFRS 9 standards, so the bank has to take up its own stand uh, and go in the process of developing models, validating the models that they have already created for the IFRS 9 framework. So we will start, and with this objective in mind, IFRS, not only IFRS 9 model development, but also IFRS 9 reporting and all. So everything, everywhere, this particular module is, or this particular regulation is doing the rounds. And in expectations of that, and in line with that, what I've tried doing over here is I tried offering a module which will help you understand the basics of IFRS 9, right? So at the end of this module, you can expect to have a clear understanding of the IFRS 9 regulations. You can have understanding of the different kind of commercial and retail products that are there. Though, yes, the people who have done the risk modeling module with me, you know that a lot of focus on retail is done over there in uh, the credit risk modeling module. So in IFRS 9 per se, we would be mostly looking towards, or the greater focus over here would be on the commercial portfolios, right? So over here, as we go ahead, I'll just walk you through very quickly through the brochure that I have over here, right? Just the framework of just the key, the broad framework that I have with me. So over here, yes, it starts with the banking concepts. So when I talk about an introduction to the banking portfolios, I mean to talk about the different kind of products that are there in the bank's portfolios. But this time when we talk about it, we go more details. We go into the greater detail. But unlike what we had done for our credit risk modeling purposes, we used to look into the product more from its risk aspects. Over here, we are going to look into it more from the accounting aspects, more from the product aspects, right? So, so from there, we move into talk about the regulatory framework, the key regulatory frameworks. But when I talk about the regulatory frameworks, my discussion over here would be mostly focused on the regulatory frameworks for CC on the regulatory frameworks on provisioning per se, right? I would not be talking about much about Basel over here or CCAR over here, but rather I would be talking about the different kind of accounting principles that have been there. I mean that rule the international accounting space in today's markets. Uh, the type of the core capital tiers that are there, and where is it, in which tier of capital does IFRS 9 actually fit in, Why is IFRS 9 actually required? How is it different from Basel? So many people, they ask me this question, not, or rather in many interviews, these questions are asked that how is IFRS 9 different from Basel? Right now, why should the comparisons be made? Why should that comparison should not be made? These are something that I would be talking about in this particular module, right? Now, after so with topic one, we would have the framework of all the products, of all the key type of products, and what are the which are the products which should be entering into IFRS 9 assessment, which are the ones which should not be entering into it, are the things that we would be talking about. Now, similarly over here, we would be also be talking about the introduction to the so from there we go deeper into the IFRS 9 standards now. So where we talk about introducing ourselves to the bank's financial statements, right? So there are different organizations and they issue their financial statements. So what I want to do over here is I want to kind of acquaint the participants to the bank's financial statements, the profit and loss statements, balance sheets, and how are the different heads of IFRS 9 reporting done. So how does or how would the regulator expect uh, bank to report its different heads under IFRS 9? Now, after that, the next part comes in is the introduction to the IFRS 9 standards, where we talk about the scope of IFRS 9, the key asset classes under IFRS 9, the concept of the sole principal of payments of interest, etc. Then we move on to talk about introduction to commercial banking products and the key classification that is there under IFRS 9 and what are the assets, what are the standards that must be uh, that we must be talking about. Say for revenue-driven products, there is a particular IFRS standard. For trade and contract receivables, there are separate IFRS standards. For lease, there are separate IFRS standards. So we'll be talking about all these IFRS standards in details, right? So not much. So more than the statistical modeling part, a lot of focus would be there on the accounting part as well. Now, after topic one and topic two is completed, then we move to topic three, which talks about the basic modeling approaches, right? So over here in this particular module, I would not be rather talking about what logistic regression is or how logistic regression is built up, is developed, what are the measures, but rather I would be taking it relatively to a more advanced level where I would be talking about different kind of extrapolation methods, Markov chain processes. I would be talking about the Pluto-Tasche method, the Vasicek transformation, and so on, which would help us estimate, which would help us convert through the cycle PDs to a point in time PD. So a lot of these concepts like TTC PD, point in time PD, macroeconomic factors, etc. So these are the measures which will be coming in, right? So over here, while we talk about the logic model, we will be talking about the logistic regression model over here, but the basic framework, we would not be going very deep into it. We will be talking about Markov processes, roll rate analysis, Pluto-Tasche method, survival analysis for PD model development. We'll be talking about loss given default modeling methods, linear regression, logistic regression, beta regression, inflated beta and exposure at default using linear regression decision trees. Or mostly the EAD figures for us would be given over here because because these are commercial portfolios, right? So you get a very clear idea about what its exposures possibly could be. But however, yes, there would be model development approaches, right? Now, after that, the next part that we talk about is macroeconomic variables. How is it that macroeconomic variables can be inducted into these modeling methods, right? So how is it how would you choose a set of the core macroeconomic variables, right? Uh, as affecting your portfolio. So, what are the reports? How would you reconcile reports and your statistical methods of choosing your macroeconomic variables, right? How would you, and finally, how would you validate or review an IFRS 9 model? What are the industry best practices for validating IFRS 9 models. So basically, if you have an IFRS 9 model developed by your bank and you need to monitor it or review it, how do you go about doing it? So unlike the credit risk modeling module, which is very quantitative in nature, and we talk about statistical models and methods, so the concept of statistics, the basic statistics, is being left out over here, and more the focus is being brought into on the business side, on the regulatory side, and on the modeling side. So the modeling over here would be the extensions of the models that we have learned under credit risk modeling module, right? So in this way, so this is precisely what the IFRS 9 module is all about. Right? So is this clear? So basically at the end of the module, you can expect to have a clear understanding of the following parts. Number one, uh, the, the key regulations which drive the provisioning of funds in the banking industry. So the key regulations would incorporate the financial accounting standard, the results published by the regulations published by the Financial Accounting Standards Board, the regulations published by the International Financial Reporting Standards, that's the International Accounting Standard Board, IASB, right? And the whole set of regulations, the accounting principles, which has been published by GAAP as well as IASB. Also, you would have a clear understanding of the FAS 5, FAS 114 regulations, which has now been replaced by CECL framework, right? And above all, you will get a framework understanding of IFRS 9 as well. So that's the first takeaway that you would have. You would have a clear understanding of these modeling frameworks, or about these regulatory frameworks, right? So as you move across regulations, you will be able to identify how is it that you know that these regulations have evolved over time. How has the definition of the bads, how has the provisioning measures evolved over a period of time, right? So that's one part. Now coming to the next part, what we also have over here is the introduction to. So after this, you'll be able to get a clear understanding of the IFRS 9 standards in respect of its core, the key products that it applies to. What are the key tests that asset must pass to be qualified to qualify for the IFRS 9 standards? Uh, the key classifications, the asset classifications under IFRS 9, and so on, right? And the third most important part is you have an in-depth understanding of the modeling methods. That how is it that models are actually developed, right? For IFRS 9, how is it different from other models which are developed? Finally, you'd get an idea about the ways of validating an IFRS 9 model. Validating, when I say validation, I imply both pre-implementation validation as well as post-implementation monitoring, right? So all these parts would be talked about in details, and we will talk about as to how these things they go about and how do they fall in place with one another, right? So it must give you an end-to-end understanding of working in the uh, plane of IFRS 9, right? So that's the overall framework. So any questions up to this point? If there are any questions, I'll take it up and then we'll proceed to the next. Okay, so is this part clear to us?
Yes, Tanmay.
Great, great. Uh, okay, so having laid the framework of this background, right? So let me just introduce the platform, or let me just introduce the group that is there in this particular module, who has shown their interest on this particular module. So let me just start off with Anshul. Anshul, it would be great if you could just unmute yourself and just unmute and introduce yourself to the team.
Yeah, sure, Tanmay. So I'm Anshul and I have been working with IT industry since say 9 years, 9 to 10 years, and I've been associated with banking projects as a consultant for various implementations of banking solutions, be it mortgage areas, resolution process. Um, so these are the alternates if a customer is not capable of paying his monthly commitments. So Irish Bank provides various other alternatives for him to meet his financial monthly commitments. So this is one of the very critical regulations for which we implemented for one of the big four Irish bank. So this is particularly into the area of mortgages. So my area is basically into consulting into mortgages, and recently also I have been starting contributing into the credit risk area, wherein I have developed, I have a rough idea of developing this PD, LGD, and EAD model on SAS Enterprise Miner tool. So this was a little bit background about my what I work, and basically I'm an engineer and master in management as per my qualification.
Okay, thank you, Anshul. So that was Anshul for you guys, and now from Anshul, I move on to Harish. Hi, Harish. Please introduce yourself to us.
Yeah, hi everyone. This is Harish here. I'm a B and MBA by qualification, and I have over 7 years of work ex. And I work majorly into customer analytics and retail analytics. And from past 1.5 year, I'm into credit risk modeling, and presently I'm handling an IFRS 9 project implementation. Thank you
And
all.
Okay,
which company you are with? Which company?
I work for Genpact right now.
Genpact, this Delhi NCR, right?
No, it's in Bangalore. I work for an auto finance client, so we are in the implementation stage of IFRS 9 there. I
okay,
base out of Bangalore.
Mhm.
Yeah.
okay, okay. Thank you, Harish. Thanks a lot. Thanks a lot. Nehal, if you could just unmute yourself and quickly introduce yourself to us.
Hi, thank you, Tanmay. Yeah, so I'm Nihal. I currently work with a group risk measurement team at Standard Chartered, where I am responsible for all the risk models to be developed on the retail products. So, be it your scorecards, be it your PDLG, DAD models, or your IFRS 9 models, or stress testing models. So, I work on all of them. And uh, yeah, so prior to this I kind of used to work with the Wells Fargo, and yeah, so I've been in credit risk modeling for the entire length of my career, which is around 3.5 years. Thank you.
Great, great. Hey, hi, Piyush. Yeah, it would be great if you could introduce yourself to the team.
Yes. Hi everyone, I'm Piyush. Actually, I'm currently working with RBS, so I'm currently working traded risk controls data quality. So I think it's been 2 years I've been working with RBS, and I did my master's from IIT Delhi. So this is, and my interest has been into, I mean, I wanted to move into credit risk modeling. That's why initially I've been part of DexLab Analytics. So wherein Tanmay was the facilitator, so I was getting trained on credit risk modeling. So that's why I joined this batch. Thank you.
Okay, thanks, Piyush. Thanks a lot. Yeah, hey, hi, Pradeep. If you could, it would be great if you could unmute yourself.
Yeah, sure. So hi everyone. I'm Pradeep, and I've been working in the analytics industry since 2011, and I've worked across different teams as such, but never into modeling. So I'd give you a quick overview of my career. So started working with Barclaycard, and that was in the UK, Northampton. I had been there for my master's in financial management, and I started working there and then continued working with Barclays in India, and now I'm in HSBC. So the teams that I've worked in are the global portfolio insight and analysis for Barclaycard, group risk in governance teams in Barclays Shared Services in India, and within HSBC, I've worked for group risk strategy as well as financial analytics. So I'm currently in the financial analytics team, and it's a slight shift from what I've been doing in credit risk, where the focus was mainly on looking at minimizing the losses. But right now it is more the focus is more on to increasing the revenues and the sales, and looking at the marketing costs and things like that. So the experience has been quite spread out, but the only thing missing would be the modeling experience. So that's the reason why I took up this training. And also in my current role, there is a slight tilt towards IFRS 9 reporting implementation, which I've successfully done in the last 1 year, and it's up and running. So my focus is now moving into the background of how IFRS 9 models work. So that's the reason why I'm doing this training now. And education wise, I've got a master's in accounting and a master's in financial management.
Okay, so thank you, team. Thank you for introducing each and every one of us. So that's great. Great having you guys over here. And this is a fairly senior population and a senior audience, and I believe there would be a very strong exchange of understanding and knowledge, and not a one way which generally happens. So I really look forward to this discussion going forward. Thank you, guys. Thank you for your time, and thank you for giving me the opportunity to help you out as much as possible. So before I start, just a brief introduction about myself. So I am basically a MPhil in economics with my specialization into financial econometrics, game theory, finance, and experimental economics, right? So I happen to have dual specializations because of one because of my MSc degree and the other at my MPhil. So since then, I've been very interested into the quant side of things, but I had started off my career as an academician, teaching for around 2.5 years as an assistant professor in a college, and from there, I had moved on to the industry, right? So after that, since then, I have been working with the industry, and throughout the last 4.5 years of my career, I have been involved into model development, validation roles across into credit risk. I am really fortunate to have bumped into the domain right at the beginning of my career, and since then, I have been working into it. I have worked across regulations. So I worked on Basel, I worked on FASB, I worked on IFRS 9, and now I have the opportunity of working on business models as well as IFRS 9 in my current role. So there has been a lot of, it has been a mixed basket. But yes, the broader domain of my expertise has been around model development and validation, right? And given that teaching has been always my kind of passion, or the area that I've been, or my soft corner, so I try to deliver these sessions which help people to make a move into the domain that they want, right? So that's broadly about myself, right? While we were discussing, I can see some of a new participant joining in, Toon Matthews. Now, let me introduce Toon to you guys all, right? So, this IFRS 9 module was launched because Toon reached out to me one day asking for assistance around IFRS 9, right? When I thought of kind of uh, starting this module, right? So, Toon is based out of UK, and she herself is a PhD in economics, and she started working in the industry recently, right? So that's a broad overview about her. And Toon, it would be great if you could unmute yourself and give your introduction to the team. So these are some of the people who have joined, who have shown interest in the IFRS 9 module, and have kind of decided to attend these demo sessions. So hi Toon, good morning. and it would be great if you could introduce yourself to us.
Hi, good morning. My name is Tone. I'm interested in FRS9, like you mentioned, Tamoy. I studied economics. I have a background in economics a couple of years ago, but I want to go into the industry of risk, credit risk. So that's why I want to study at FRS9. Thank you.
Thank you, guys. Thanks for the introduction.
Yeah.
So, yeah. Yeah, so you can mute yourself while I start the discussions. As and when you have any queries, you want to feel free to reach out to me, right? And we can get started from there. Great. Uh, so I'll just I'll just update the flash. So guys, just give me a sec. Let this thing just roll up. Okay. So I'll just clear this. Just give me a minute, guys. Okay, just let this load. Okay, so let's get started. Fine. So over here, okay. So just to get started off, so basically as per the syllabus, if you look into the syllabus, so topic 1 starts with introduction to banking concepts. Right? So, however, whenever so the discussions that we take up from here would mostly be designed or mostly be aligned to talking about provisions, right? Now, before we move on to provisions and all, so let's start understanding. So let's try to understand the basic function that a bank plays. So as we know, very simply, it takes care of investments and savings, right? So its major function is to channelize the funds across the economy, right? So there are some people who are keeping money with the bank, and the bank takes those money and lends it out to business people, and in between they make a profit because they are borrowing from a low risk segment and they are lending it to a high risk segment, right? So that is precisely what a bank simply does. Now, from our understanding of credit risk, we can say that the very fact that the bank will make a profit from the lending is contingent on the fact that the person to whom the bank had given the loan returns the money with the interest, right? However, if the person does not return the money with the interest, then the bank will be in a problem, or the bank will be in a situation where they cannot pay back uh, their depositors, right? So in order to do this, in order to so whenever a bank sees that there is always a chance that there's a high chance that a particular person may not return back the money, the bank always keeps a provision against that person, right? And that provision is very simply known as the provisioning of the bad debts, right? Now, previously, so at the very basic level, provisioning or provisions are studied as a accounting identity. However, with time, as and with as the portfolios become more complicated, lenders become more complicated, borrowers become more complicated, right? So things need to be very regulated and driven, especially after 2008, right? So that is where this landscape of provisioning uh, frameworks come into play, right? So before we move into understanding like what exactly is this provisioning, why the provisionings are done, and so on, so let's just start from the financial statements that a bank has, right? So any bank has two major types of financial statements. They have, broadly I'm saying, two final account statements, right? Now, what's a final account statement? Now, generally, final accounts comprise of three parts. One is called a trading account. The second is called the P&L statement, the profit and loss statement, and the third is called the balance sheet, right? So over here, Sephora Bank, we will mostly be concerned about two major final accounts, right? So one major final accounts over here is one final accounts over here is the P&L statement or the profit and loss statement. So one part over here is the profit and loss statement. So this is called the P&L statement. P and L, or the profit and loss statement. And the second final accounts that we would be concerned with is the balance sheet. Is the balance sheet. Now we need to understand that whatever so whenever we are developing any models or something, we are trying to cater to either the P&L head, or we are trying to cater to a balance sheet head, right? So P&L or a balance sheet, right? So let's first of all look into what are the components, or how would a P&L statement look like, and what exactly is the output that a P&L statement would have. So basically over here, if I think about it, the P&L statement gives an idea about the profit and loss that the bank has earned, or rather it reflects the net profit or the net loss that the bank has earned. Net profit or the net loss that the bank has earned. profit loss, right? So the question that comes out is, how do I reach to this net profit and loss that the bank has earned? So when I say it's a net profit and loss that I have over here, now if I talk about the net profit and loss, so let's see what this net profit and loss comes from. Where does it come from? So it comes by comparing, by weighing the income which the bank earns versus the expenditure that the bank makes, versus the expenditure that the bank makes, right? So it's the P&L statement is nothing but it's the record of the income and the expenditure made by the bank, right? And if the expenditure exceeds the income on the whole, then it say that it's a net loss. If it's the other ways around, it's the net income, right? So over here, when I talk about income, so what is income over here? Now income over here is so any income which the bank earns. Now the income over here can comprise of both interest incomes, versus non-interest income, versus, so plus, not versus, plus non-interest incomes. Now, when I say that there is an interest income, I mean the income that the bank earns from the loans, right? Plus the non-interest income. Non-interest income can imply any income which the bank earns other than loans, other than from lending. So, for example, say there is an interest income. So, for example, if the bank does certain consultancy for the clients, or the bank helps in someone's investments, and in return they get a fee, right? So any fee-based income is the example of a non-interest income, and the bank has multiple kind of fees. The bank has trust fee, the bank has some processing fee. So any fee-based income is a non-interest income, or any other sources of income which the bank earns apart from the interest is your non-interest income, right? Now expenditures that a bank faces, the expenditures that the bank faces are any kind of expenditures of maintaining any products or any services. So that the cost borne by the bank to render any specific service or something like that, right? So it has these characteristics. So it's income and expenditure, right? So over here, so in expenditure, so what are the things that we have during in our like what are the things that we have when we talk about expenditure? Now expenditure can be any kind of promotion sales expenditure that the bank incorporates on any particular credit product, right? Which can be sales expenditures. Now, after sales expenditures, we can also have other kind of expenditures like product expenditures. So by product expenditures, I mean that, say, suppose the bank is giving you any cash back on your credit cards. So that's a product-based expenditure which the bank is making on the cards, right? So the bank uh, waivers a kind of or some kind of processing fee. So that's a cost which they are actually foregoing, right? So that's a cost which they're actually allowing you to take off your books. So these are typical kind of your expenditures, right? So there are also other expenditures. There are regular expenditures such as electricity bills, telephone bills, and other billed expenditures and so on. Now the difference between these two is your net profit. So once you adjust this income versus expenditure to your gross profit, right, what you get is your net profit, right? So over here, so how would the P&L statement look like? So the P&L statement of a bank would very simply look something like this. So you have this thing. So you have income over here, income, right? And what you have is your expenditure, right? Now, after you have sorted for all your income and expenditures, you end up with some kind of profits. So profits I will denote it by pi, right? Now this profit is, so after you've done your income and expenditures, you now have earned your profit, right? Now this profit is adjusted to something before you decide whether it is going to be a net profit or a loss. So over here, now from this profit that you earn is something uh, which is very important for the business to survive. Also, it has many components. Now, one of the part is that one part of this profit will go out as stakeholder dividends. Stakeholders dividends. Stakeholder dividends. Now, when I talk about stakeholder dividends, so one of the important parts for which this profit is used is the stakeholders dividends, right? Now, the second, another important part for which it is used is your retained earnings. So, out of the profit that you have earned, you keep back certain portion as retained earnings. That is, this is to be plowed back investment in the next year. So, this is the next part is your retained earnings. Is retained earnings. Now, the bank is happy with both these two parts, right? Now, the next part that comes in is the most dubious part, and that is something which creates all the problem with the bank. So, another component of this profit is kept aside as the provisions for bad debts or provisions. This is provisions against the impairments. So basically what I'm trying to do over here is I'm trying to identify that. Now one thing that you can identify from here is that if this provision part rises, right, the stakeholder dividends are going to go down. right? Because a share of the profit is being diverted from both retained earnings as well as stakeholder dividends. Right. Now, this provisions against impairments are is that part which takes out or which encroaches on the share of profit which is kept aside for shareholder dividends as well as on retained earnings, right? Now, on retained earnings, that is totally up to the bank. The bank would say keep aside some amount of money and keep the remaining go out as profits or shareholder dividends, whatever. However, if you have a look into this provision against impairments, right? So the larger this component is, the lower is the stakeholder dividends. So over here, what I have is I have provisions against impairments. Also, what I have is stakeholder dividends, right? And these two are like kind of, you can say that an increase in one would obviously cause a decrease in the other. And this is where the bank comes into or comes under an optimization problem. Now, this is a growth versus sustainability issue. Growth versus sustainability issue. Right. So growth versus the sustainability issue. Now, if the bank undermines the provisions, let's say they 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 keep lower provisions, right? And they give greater dividends to shareholders. The shareholders would be happy and they would be willing to invest back more into the banks, right? So that is where the growth part comes in. On the other hand, if the impaired or if the suspected impairments actually turn out to be impaired values or they actually turn out to be impaired accounts, then the growth versus sustainability is questioned. So then the sustainability of the bank is questioned, right? So therefore, what would happen over here is so what would happen over here is that we would be actually in a problem, right? So we need to optimize somewhere between these two. So I need to understand how much of money should be kept aside for stakeholders and how much should be kept in for provisions. Now, previously, bankers will always be of the view that first set aside stakeholder dividends and then set aside provisions. And the idea behind doing that and the outcome of that idea was seen in 2008 financial crisis, because when all the toxic loans were given out, none of these loans had a substantial backup, right? So when the borrowers defaulted, the banks also had collapsed. So therefore, the object now, the the vision towards provisioning in today's day is that you first keep aside optimal provisions and then you keep aside stakeholder dividends. But putting in an optimal provision is always a opportunity cost, because every time you are keeping aside of money as provision, you are always foregoing some amount of a chance. So you are actually foregoing substantial amount of loan. I mean, you are actually foregoing an opportunity to pay to the stakeholders, and that in turn is bringing in a reputation risk for you. So there are a lot of these challenges. So the question that comes out is that what should be the optimal provision? So what should be the optimal provision? So what should be the optimal provision? Because every time you keep aside, if I keep aside very high provisions, I will be keeping aside a lot of idle capital, right, which could have been invested profitably elsewhere. But if I keep very low provisions, I may be investing it somewhere else, but in case of defaults or in case of impairments, I may end up with a bankruptcy risk, right? So what should be the optimal provisions? And this question leads to the formulation of a whole set of regulations all across the world. And what are those regulations? One set of regulation is your FASB regulation, the financial a set of regulation which has been issued by the Financial Accounting Standards Board, right? The second set of regulation that you have over here is the IFRS regulations, right? Now, the FASB regulations after some time had become the CCL regulations, as well as there are other regulatory norms which are there throughout, which are mentioned, right? So, you also have measures like incurred loss approach. So, incurred loss measures.
So how this FASB, so any more details about this FASB and incurred
I'm
loss
coming to that.
approach?
I'm coming to
Okay.
that. I'm coming to that. So incurred loss approach and all. So there's a whole set of regulations which has been framed around this optimal provision. Now, what are these incurred loss approach FASB IFRS guidelines? So these are nothing but they are a guideline or a framework suggesting how best can provisioning be done, or how best can provisions be done. These are guidelines for effective provision. This is the guidelines for effective provision. Right. So this is the guidelines for effective provision.
Tanmay, I have
Clear?
one question.
Yeah.
Uh, like when we build models for provision, is there a certain percentage that we keep money set aside for like for impairment?
Yeah. So basically, the output that your provisioning model will give you the percentage that you need to provision. So out of a certain amount of profit, that percentage will be provisioned. So when you are actually computing your ECL or your expected credit losses, so what are you doing? You are trying to find out an expected loss that or expected credit loss that you are expected to earn in the next 12 months or in the lifetime, right?
Mhm.
So that's the figure that you are trying to identify. That's your optimal figure. And how do you ensure that's an effective figure? Because you have three effective feeder models going into it, the PD, LGD, and the EAD, which is giving you the expected credit loss, right? Now,
Correct.
this ECL figure that you get is some percentage of the total profit, right? So that's your ECL percentage.
So,
Right.
so Tanmay, the same thing is what Basel is doing, rather than the only difference is the naming convention which is used here in
No,
IFRS 9 is provisioning, and in Basel it says capital adequacy ratio. So over there
no.
also we are setting aside a certain percentage of expected credit loss, expected loss.
Yeah, but from that expected loss, you are not computing that expected. I mean, your expected loss is the not sole objective of Basel. Your expected loss is computed over there so that you can reach your unexpected loss. right? So ultimately, the objective of Basel is not to show you how you provision. Its objective is to show how what percentage of capital do you set aside. Over here, I am setting aside a certain percentage of my profit against the expected losses. So provisions essentially take care of expected losses. It does not take care of the unexpected loss, which actually Basel does. Basel actually talks about identifying an optimal capital. So capital adequacy ratio, how well are you keeping aside, or how adequate are you capitalized? So that adequate capitalization is used to capture the unexpected loss, right? So it absorbs the unexpected loss, and that
So
is a, so Basel tries to capture the unexpected losses, whereas, I mean, the Basel capital or the capital of a bank tries to capture unexpected losses, whereas the provisions captures the expected losses.
so that means so that
Uh-huh.
means that Basel should have advantage over IFRS 9 because Basel is computing ECL as well as
No, no,
unexpected
no, no,
ECL.
no, no. That was my very next point. I would be coming down to this point in the very next discussion, right? So
Uh,
you cannot compare Basel and IFRS 9, first of all, because
so, but one
IFRS
more.
9 is very specifically a provisioning requirement, right? Whereas Basel is it's a framework which ensures that the bank is adequately capitalized. So Basel's key focus is on the unexpected losses, whereas IFRS 9's focus, or this reporting standards focus, is on the provisions. That is the expected losses. So if you see over here, the provision that I'm talking about over here, is essentially a P&L item. And as we would see later, I would come down to this part. Provisions, or allowances for loans and lease losses, as we often call it, is a component of tier 2 capital of a bank. It's a
So
component
in
of
other
a
terms,
tier.
can we say that?
Tell me.
So in other terms, can we say that IFRS 9 is basically considering the provision for for stakeholders profit optimization, and Basel is basically to meet the central bank regulations of capital adequacy ratio to keep the bank functioning and operational and running.
Exactly,
No,
exactly.
or
That is
yes.
what Basel does. So let's not say a central bank's requirement. So basically, the central bank uses the Basel as a, or recognizes Basel as a adequate framework which can help
Okay.
help them ensure the capital adequacy of the banks under them, right? So if you say that, so what Federal Reserve does is Federal Reserve uses Basel as a reference framework. They feel that of all the frameworks, Basel as per se is an effective framework which can help them get, you know, which can help them ensure capital adequacy for their banks. However, if you move to the European regions, Basel is not implemented exactly per se the way it is done in US. So they follow a regulation CRD4, so which is the Credit Requirement Directive. They follow the CRD regulations. Now CRD is itself an adaptation of Basel. So whatever Basel says, CRD also says the same thing, but it has minor changes, right? So we often make the mistake of saying that this bank is doing Basel for regulatory compliance. No, it's on the other side. The regulators feel that Basel as a framework is apt for this given economy, and hence they prescribe that the bank should try to become adequate as per the Basel framework, right? So it works this way. And when I say provisions, now for provision, I need to optimize my provisions. But what are the grounds of optimizing that provision? On what basis will I optimize that provision? I will optimize that provision basis a framework, and that framework is provided by IFRS 9.
Okay.
So Tanmay, whether it's IFRS 9 provisioning or Basel capital adequacy requirements, it's both for the benefit of the stakeholders at the end of the day. Even though Basel has been, it's been promoted by the regulators, but essentially it's for the stakeholders both ways,
Yeah,
whether it's IFRS 9 provisioning or whether it's a capital adequacy. It's basically to save the bank.
correct. Yeah, so at the end of the day, it's correct. But you know what? Stakeholders are people who just love to see their cash boxes ringing, right? So Basel gives you, when Basel says that okay, you need to keep aside this amount of capital, right, to ensure that your bank is stable. So again, somewhere this money comes out from the profit itself, right? So what happens at the end of the day is that the regulators feel that they get lower dividends. So hence they feel that their expectations are not being met in the short run. However, if you see in the long run, this capital adequacy ensures the bank in having a kind of a systemic, it gives a systemic stability to the bank, right? And therefore the dividends, the shareholders can keep on reaping the dividends for a longer period of time and in a more sustainable manner, right? But often shareholders or stakeholders look to the short run, and this is where it makes the difference, right? So not all stakeholders would have, or not all shareholders would have the same long run vision, right? There are many short term stakeholders as well. So that is where the challenges come up. But at the end of the day, yes, it is for the benefit of the stakeholders. It is done for the benefit of the economy as a whole. Because if a bank collapses in an economy like India, it can have very severe repercussions, right? Now, given the fact that Indian banks are being infested with so high NPA problems these days, right? And with the recent events of these these bank frauds which has happened, so that exposes the bank to very high severity, because in India there is a class of people who thrive on the interest given by the banks, because if the banks collapse in any way and a bailout is not done, then there would be many people who would be committing suicide. It can lead to mass suicides in India as well. So the economic implications of stability for a developing economy like India is very high. Whereas the story on the other side, like if I talk about structured economies like US and UK, you will see that they keep the money in the banks as well as they invest it elsewhere, right? Now, if banks collapse, what happens is the huge amount of money is spent in bailouts. Now, the taxpayer over there realizes that the money that is going out is from their pockets, right? And hence, this is not something which is looked upon positively. Also, it leads to huge scale unemployment if it's a very systematically important large bank. Like when Lehman Brothers crashed, right? It led to an increase in the unemployment all across the world, because Lehman Brothers was a globally systematically important financial institution. So to ensure that these systems are stable, right, these regulations have again and again been coming in, and reinforcing these regulations has been taken very seriously by the regulatory and the monetary authorities, right? But at the end of the day, yes, as you correctly pointed out, Piyush, Pradeep, it's done for a long term, a more stable, and a more substantial or a larger gain of the economy as a whole.
Tanu, I have a question here. I'm backing it up
Yeah.
a bit. So when we talk about the P&L statement, I'm going there. So
Uh-huh.
where does fraud stand in the P&L statement? And one more question would be, there's this concept of account receivables. Now,
Right.
so where does that factor in the income, and till what
Okay.
time and when? Yeah.
Okay, so account receivables, I'll be coming to account receivables a little later, right? So account receivables does not feature in the P&L statement, it features in the balance sheet because account receivables is an asset to the company, right? So if there is say a receivables of 3 lakhs, which I expect to get over the next 1 year, right? So then that's an asset that I'll be recovering, that I'll be getting over a period of 1 year. So that account receivables will feature in the balance sheet.
So the income is basically what you have gained, not something which you expect in future. So
Correct.
that's what
Correct.
income is. Okay, thank you.
Yeah.
And how about the fraud thing, if you could explain that?
So fraud, I'm not absolutely sure whether it would be featuring in the income statement or not. Right. I believe if there are frauds which are happening, right? Yeah, though they should ideally, you know, impact the P&L statement because that impacts the profit of the bank for that quarter. I'll just check on the exact treatment of frauds on the P&L statement. I'll just
So,
check on that.
Tanmay, I think the fraud losses, if they are identified, should come into the P&L
P&L
statement as a
statement. Right.
loss.
Right.
Yeah.
Right.
So that's how it
No,
reflects
no,
in the
but
P&L.
If I remember
so
correctly,
I
I mean, again, I'm not sure here. They do not feature in PNL. I was just asking because I was confused. So I think they're set aside as a different thing. So also they're
See, there can
depending on
be
the name.
a separate treatment, the accounting treatment
Yeah,
of fraud. So just let me
yeah,
check that and I'll get back to you.
sure.
Sure? Yeah. Great.
so I
Yeah.
want to share my understanding here on. So I want to
Uh-huh.
share my understanding on this fraud. So fraud actually should not be captured something into profit and loss statement because fraud is something which is basically a robbery, a kind of a robbery. So robbery cannot be treated into a profit and loss. It is something which will and which should be recovered by these enforcement directorate, and then these should be put back into the statement. So that is something which should be into the profit and loss statement as something which is yet to be realized or yet to be recovered. Because default
Uh,
can lead to loss, but this fraud is something which is actually due to this some infrastructure issues and some kind of flaw in the system.
Right.
Okay,
Yeah,
basically,
so that's my
it's not a
understanding.
business. Yeah, it is not a loss which comes because of the business, but it's something like an operational
Yes.
hazard, you can say, or an occupational
Yes.
hazard.
Yeah.
Okay.
Yeah. So, anyways, just let me check the exact thing and I'll get back to you guys. Okay. So, just coming back to the part where I was, right? So basically, one thing that we can see is that when we talk about provisions, right, when we talk about effective provisioning, or when we talk about guidelines for provisions, right? So basically, one thing we can see that an effective provisioning is really important because it has respective short-term and long-term impacts, right? And when we have short-term and long-term impacts over here, uh, so basically we need to understand how this provisioning should be done, right? And one very important thing that we have seen over here is that provisioning is done to ensure, or it's a P&L treatment, which is done. It's a P&L item, it's a profit and loss item. Now, before I go more further into provisions, let me just come back to the second final accounts, which is your balance sheet, right? So, how does the balance sheet of a bank, or how would the balance sheet of a bank really look like? So if you have a look into this, okay, guys, just give me a second. Okay, so let's have a quick look into the balance sheet of a bank, right? So how typically a balance sheet appears. So it's like you have the asset and you have the liability over here. Generally it's written the other way around, right? So you have the assets on this side and the liability on this side. So within liability you have something called a head called the capital. Trigger. So what we have is the capital. Now the accounting equation says that the assets that the bank has, assets should be equal to liability plus the capital plus the capital. So over here, what we expect to see is that the assets that the asset on the being on the left hand side, liability plus capital being on the right hand side. So liability plus capital must equal assets, and that is the accounting equality, right? Now again, when we are talking about capital, now in determining this capital optimal, we require, what we get is, for reference, what we get is the Basel framework or the BCBS standards. The Basel framework, right? So over here, now why the question that comes out over here is, why do we need capital, right? So before we go into this question of Basel, is Basel better, is IFRS 9 better? So let's try and address the question that why do we need capital if we have provisions, right? So to do that, I'll draw up a very famous diagram which is found in almost all regulatory texts, and that is the loss distribution diagram of a bank, right? So over here what you would have is your time. So you over here we have the loss values, and over here we have the relative frequencies of the loss distribution frequencies, right? Now let's just draw this graph. So this is how the loss distribution typically looks like. So I'm doing a freehand diagram. The Basel diagram is much better. So if you have a look into this part, now what is the expected loss that we can make? Now the expected loss over here is the mean loss. So now this is a right skewed distribution, right? So over here, this is the median that we get to see. So this is the median that we have over here, right? Now, so this is the mode that we have, mode of the distribution. The median of the distribution is somewhere here. So if you go over here, this is the mode of the distribution. This is somewhere which is the median of the distribution. And this is somewhere which is the mean of the distribution. So this is your mean, or this is your expected losses. This is your expected credit loss, or as we call it, the expected loss over here in the Basel chart. So this is your expected loss that we have, right? Now over here, the fluctuation from the loss that we have over here, so at this point, this variance or the variation that we have is your unexpected loss. Is your unexpected loss. Now, this part is your EL, and this part is your unexpected loss. So what do we make it from the diagram? So from the diagram, what we can make out is that the expected losses which actually occur are very high in frequency. So they occur very frequently, but the exposure that they have is actually very small. So I have the expected loss as a very small exposure, right? So expected losses are not very dangerous. So they, even though they occur very frequently, they occur. So they occur up after so they may occur very frequently, but their overall exposure or the volume of the loss is actually very small, right? And these can be covered up by provisions. However, if you look into the unexpected losses over here, right? Now the unexpected losses that we have over here is something which is different, because in the unexpected loss, what happens is that your probability of occurrence of unexpected loss is very low, but the volume of the exposure is actually very high, right? So from that perspective, what we can see is that unexpected losses have very huge exposures but very low probability of occurrence. On the other hand, expected losses, I repeat, has very high frequency of occurrence but very low exposures. So therefore, they both of them cannot be maintained, or both of them cannot be captured by one single source of fund, and hence we need to distinguish between the sources of fund. Let's say I want to capture both expected losses and unexpected losses by the provisions, right? Or I want to capture them using my expected losses. Now observe that provisions, right, the amount of provision that is there, or the credit risk premium that we call, right, is something which enters into the risk based pricing. So when I'm pricing the product, the amount of provision that I'm holding back, or the credit risk premium, is actually charged to the borrower, right, who is asking for a loan. However, if I am to keep aside both EL and unexpected losses using provisions, the price of the product would be very high, right? Because the unexpected losses are of smaller frequency but of greater exposures, correct? So that is the reason. So therefore, what we are trying to do over here is we are trying to keep aside provisions for expected losses. So whatever average or expected losses or small exposures are obtained, I'm putting them aside. Whereas the unexpected losses, which are of a larger exposure but lower frequency, is taken care of by the capital, right? So that is where these two sources or these two parts of losses, they bifurcate. So any kind of expected losses which are of small in magnitude but with greater frequency are taken care of by provisions, right, which enter into the pricing, and the unexpected losses are taken care of by the capital of the bank. Clear? So that is how the two are bifurcated in terms of their uh, you know in terms of the loss absorption. So expected losses absorbed by provisions, unexpected losses by capital. Why? Because expected losses are of low magnitude, high frequency, hence they are adjusted into pricings. Now if unexpected losses was to be included into provisions, the product prices would have been so high that no one would have been buying it, hence they are managed by the capital, right? Now the question that
Yeah.
comes out over here is that these unexpected losses are managed by what type of capital?
Uh,
Yeah, tell me.
here. So, so the change in the fair value of a collateral would
Uh-huh.
be into would be counted into unexpected credit loss or expected credit loss.
Expected losses.
So, for instance, so IFRS, it would mean expected losses.
Right.
Okay, okay.
Okay.
So just because during 2009, this was the reason that the value of the collateral fairly decreased, but
Mhm.
it was displayed as a very high value in the accounting terms. So that's why this fair value treatment was this.
Yeah.
There is some provision of this fair value within IFRS 9 only also.
Correct. Correct. So we'll be talking about this fair value terms when we come to IFRS 9 itself. So first of all, what I'm trying to do is I'm trying to space out the scope of IFRS 9, right? And then we will go ahead and we'll take up all those portions over time,
Okay, okay.
right? Okay. Great. Okay. 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 Fine. So, so the question that comes out is that unexpected losses are absorbed by capital, but what type of capital? Now, when I'm talking about capital, right, let us try to understand that what exactly is the type of, what are the different types of capital that are there, which would actually, or how is it that the bank's capital structure would be designed? So, bank typically has three kinds of asset tiers, right? So first is tier 1 capital. Tier 1 capital. The second is tier 2 capital. And the third is the tier 3 capital. Right? Now, unexpected losses has to be absorbed specifically by the tier 1 capital of the bank. So what is a tier 1 capital of the bank? A tier 1 capital of the bank is the pure or the equity capital of the bank. So this is the purest form of capital, or this is also known as the equity capital of the given bank. Right now, equity capital is the capital which has been raised from the public and hence is the actual, or as we call it, the purest form of capital. Right, so this is what your tier 1 capital is all about. Now over here, what we are trying to do is we are trying to create, so all your unexpected losses are to be absorbed by this tier 1 capital. So your tier 1 capital must be sufficiently large enough such that your estimated unexpected losses can be absorbed. Right. Now comes tier 2 capital. So what type of capital is tier 2 capital? Tier 2 capital is kind of a subordinate or an estimated capital. Now this capital comprises of estimated losses, right? And out of them, one of them is the provisions or allowances for loans and lease losses. So these are all estimated capitals, right? Now, given that these are all estimated capital, these are not actual or they are not the purest capital. Therefore, tier 2 capital is not, so tier 2 capital is kind of is a second layer of capital which is there to which is expected to absorb the expected losses, right? Or your more or less or your normal portfolio losses, of which provision is a component, right? So the one restriction that tier 2 capital has is that at max tier 2 capital can be 100% of tier 1 capital. Tier 2 capital can be 100% of tier 1 capital. Of tier 1 capital, right? So it cannot exceed the tier 1 capital by any chance, right? So capital or the tier 1 capital is used to used to absorb the unexpected losses, and the expected losses are absorbed by the provisions or allowance for loans and lease losses, which is a component of tier 2 capital. And tier 3 capital is absolutely subordinate capital, and which is not within the scope of our kind of our discussion, right? So basically, when we talk about Basel framework capital adequacy models, be it your Basel models, be it your CCAR DFAST, they are concerned about this tier of capital, right? Your Basel models, your Basel, then CCAR, DFAST, these are all targeted to have to ensure that your tier 1 capital is sufficient, right? Whereas
And
IFRS
and
9,
what is
FASB, or other regulations, they are more targeted to ensure that your provisions are adequate. So your PNL, in your PNL statement, your provisions are adequate, which is in fact a component of your tier 2 capital that is adequate. So the scope of these two set of regulations is absolutely different, and they cannot be compared as saying that yes, Basel is better, or IFRS 9 is better than Basel. So it's like comparing apples and oranges, right? So I'll take
So
a pause
Tan,
here.
and what is CCAR and DFAST?
yeah, I had the
So
same question, Tanmay. Yeah.
okay, CCAR is your comprehensive capital adequacy review, and DFAST is your Dodd-Frank Act of stress testing. So these are CCAR and DFAST are the two stress testing norms that under the Federal Reserve. So people who work in this American geographies or with American banks, CCAR, DFAST are the two key stress testing regulations that we have.
So stress testing means the validation of that model, how good and accurate it is, right?
No, stress testing means to check whether the bank has a sufficient amount of tier 1 capital which can be used, which the bank can use to survive periods of extreme macroeconomic downturns. So
Stressed
three
conditions.
separate set of scenarios are created over here. uh, so, the base scenario, adverse and severely adverse scenario, and it is clearly checked whether this thing can be done. It's clearly checked whether the macroeconomic situations can, or whether an economy can survive a situation of macroeconomic downturn. So does the bank have sufficient amount of capital to survive periods of economic downturn without getting bailed out? Right. So if the banks do not, pass the stress test regulation, then they may have to withhold their capital distribution plan, including their dividend payouts. So before dividend payouts are done, it is ensured that the bank is adequately capitalized in terms of Basel, CCAR, and DFAST regulations, and it is adequately provisioned in terms of IFRS 9 CECL frameworks. Only then can would the regulators allow the bank to go ahead with their capital distribution plan.
So by stress conditions, we mean that so the whenever there was highly stressed, the most stress period that would be considered as a stressed period, ideal,
No, there are
highest.
ways of designing stress situations. However, when we are doing CCAR validations, comprehensive capital adequacy review, so these are regulatory scenarios. So the Fed publishes these scenarios every year during CCAR season, right? And the bank needs to test in light of those situations that that whether they can survive the macroeconomic downturns. So the scenarios for CCAR is provided by the Federal Reserve, and however, Federal Reserve requires that you use the three uh, regulatory scenarios and two internal scenarios, and check whether you are adequately capitalized or not. Whereas for DFAST, the bank can use its own internally developed scenarios.
Okay. So CCAR has so the stressed model stress conditions are provided by Federal or the Central Bank of
Federal
India.
Reserve, right, right, right.
Okay.
Right? So these are the two broad frameworks. And out of this, as we can make it out, we would be focusing mostly on the provisioning requirements. Right? Okay, so now I'll take a pause over here and I'll take up questions if there are any. Toon, do you have any questions? Toon, Nihal, Harish, anyone?
Yes. Mm, like in Basel, we do regulatory capital modeling. And how is it different from economic capital modeling? Because I think economic capital, we also keep economic, what do you say, capital, it's similar to regulatory capital, right? For
No,
unexpected.
regulatory capital and economic capital are different because when you're computing the economic capital, You consider the market risk factors as well, the operational risk losses as well, and on top of that, you compute your economic capital, right? Whereas when you are computing regulatory capital, you are computing regulatory capital, or your focus is only on the tier one regulatory capital.
So does it mean economic capital does not come under credit risk?
No. Economic capital falls more under market risk than under credit risk.
Okay.
ECAP models are treated more under capital market risk.
So Tanmay, basically, I have to add here. So Basel 3 first pillar has additional 1% capital, which is for cyclic capital counter cyclic capital buffers.
Counter
So
cyclical
that
buffer,
is
right?
because of counter cyclic buffer. So that is because when the economy is down and the economy is not performing, so then 1% which is kept as a reserve should be pushed in economy for economy to boost up. So that is that economic capital which a bank has to keep a
No.
provision for.
That is not
And
economic
this is
capital. No. That is the counter cyclical
okay.
buffer
So
that you
that
are
is not
keeping
okay.
aside for meeting your, say,
So,
for
but
example,
something is that
uh
so that is something which is we are keeping for economy.
yeah, but
That
economic
economic
capital
capital.
is not that. Economic capital is separate. So economic
Okay. Okay.
capital basically says that to maintain a certain rating, say I want to maintain an A triple plus rating, right? So how much of additional capital do I need to keep aside after I have kept reserved for AL and EL and UL? So after reserving for expected losses plus unexpected losses, how much or more capital should I need to keep in order to maintain, say, a AAA rating? So that's economic capital mostly, right? So which considers market risk, all the market risk factors, and all the factors, the credit risk factors into account for computing that capital. However, the capital that you are talking about, that is the counter cyclical buffer, which is generally kept aside to take into account the macroeconomic movements, right? So it is more in terms of ensuring a through the cycle kind of a PD estimate, because one problem with through the cycle estimates is that for most of the credit products we do not get through the cycle kind of variables for developing a TP or TPC model. So mostly the models are hybrid PD estimates in Basel, right? So you add that 1% to take care of the counter cyclical movements. So it says that when you are into a downturn, you can reserve relatively less. But when you are during an upturn period, when your economy is growing, what you do is you keep aside 1% of capital for usage in downturn. So that's what counter cyclical buffer is.
Okay. And for which regulation does talks about this economical capital? Is it Basel, IFRS 9, CCR, DFAST,
No. So economic capital has a separate literature. It has a separate literature, and
and it doesn't yeah, and it doesn't come under any regulation or come or this provisioning.
ECAP is more of a business concept than a concept. But
Tanmay, I would
yeah,
just like to make a point here. So economic capital is essentially testing the solvency of the bank, and it's
correct.
quite different from an accounting capital or a regulatory capital, which,
Regulatory, correct.
yeah, and economic capital is something which you can readily use in the time of a stress. Regulatory capital, accounting capital has got its own rules in which they are computed, but that
Huh.
essentially doesn't mean that the bank has enough solvency or solvency is equal to the regulatory capital which can be used at the time of stress. So economic capital is kind of a real capital which is computed internally. Correct me if I'm wrong.
Correct.
By the
Absolutely.
bank
Unable
itself.
to
Yeah.
frame this sentence. You
Yeah.
have correctly pointed out. Thanks for
Yeah.
that.
So when we when these regulations, this Basel and IFRS 9 are already talking about the solvency of a bank, so then why is this additional economic capital required? When these compliances already assure that the bank will be
Yeah.
solvent and operational,
Yeah.
so why is it required for have this? Yeah.
Yeah, I'll try to explain this. So, on an individual basis, suppose if I ask you how much money is there in
Yeah.
your wallet, okay, so that can be said that that's what you have, which can be readily be used. You can have stocks, bonds, debentures, and apartments which all add up to your assets, which can be actually used when you actually need the money. But in reality, whatever you can readily use is what you have with you, like funds which can be readily used, that's lying in your savings account or a fixed deposit. But other kinds of asset, money also you have, which can be termed as your own asset. So that probably would be the difference between a regulatory capital and an economic capital. Correct me if I'm wrong,
So,
Tanmay.
but again, Basel has a provision for this, that the tier 1 and tier 2 capital has to be somewhere around 4.5 and 4% for Basel 3. So Basel has already made a provision that you have to keep 4.5% of your very good
Yeah,
quality capital in the tier 1. So
yeah.
above and
So
all, so
hold on,
can you treat it as a over conservative approach of a bank to keep an economic capital with itself?
yeah. See,
Yeah.
I
uh,
think
yeah, I'll just butt in over here. Then Pradeep, you can just take it up. Okay. So basically, what happens over here, Piyush, is say, let's think about it like this: that so I'm adequately capitalized, right? I'm adequately capitalized if I have this amount of capital with the bank, right? Now, the question of solvency or maintaining this ECAP comes into place when I am doing my risk-based lending, right? So if I'm doing a risk-based lending, there I have to ensure. So basically, when I'm doing a risk-based lending, there is something called a RAROC, which is computed, right? So it's called the risk-adjusted return on capital, right? So over there, you need to have a measure of capital. So when you are doing that price, so in that pricing, economic capital often enters as an input. Now, you are computing economic capital not because of any regulations, right? You are computing it to ensure that you have a certain level of solvency, and given that solvency, you would get a certain amount of rating. To keep that rating unchanged, right? As your capital level fluctuates, you are computing an ECAP corresponding to that, right? Taking into account all your market conditions and all your uh, uh, credit risk situations. Now, that capital, if you keep aside that amount of capital, that will help you maintain a certain amount of rating, say a triple A plus or a triple A minus. So, to maintain that rating, you are maintaining this additional capital, which is also entering into your computation of risk adjusted return on capital for your risk based pricing. So it's more of a business calculation which is done, it's more of a BAU calculation which is done rather than a regulatory calculation. So going by the regulatory standards, if you have so and so capital as what Basel prescribes, you are sorted, right? But this is an additional capital which you look to create so that you can maintain a certain level of solvency, the certain level of rating. Because if people know that okay, this bank has this rating, right, and it's safely solvent, then that would attract more investments to the bank. So ECAP does ensure in bringing in certain amount of business and growth to the bank as well as it helps the bank in conducting its risk-based lending or pricing the product basis the riskiness of the borrower. Right? Pradeep, feel free to pitch in if you have anything more to add.
yeah, yes, Tanmay. Yeah, I think that's it. That's it.
Right, so you need not submit your ECAP calculation to the regulators. You need not submit that, right? But you can use that. So, but you can use that for performing other kind of pricing activities. You can use it for to ensure a certain level of rating that you have. So,
Tanmay, you just mentioned talked about TTC, right?
through the
Uh,
cycle PD, right?
cycle, right? What is it? I guess for PIT it's for 12 months, right?
No, no. PIT is a point in time PD, right? and TTC is a through the cycle PD. So let's park the discussion on PIT and TTC for the next classes, because I'll be taking this up in in greater details, right? So PIT PDs are those PDs which are kind of, just hold on a second, guys.
Sure.
Okay, hi guys. Yeah, so let's park the discussion on point in time PD and through the cycle PD for the time being, right? I'll be taking them up in greater details when it comes. So first of all, our objective over here is to clarify on the scope of IFRS 9, the scope of the other regulatory models that are there, right? So, as is that part clear to us, right, till now?
Yeah, I'm just listening. I'm fine.
Okay, so are there any questions? If you have any questions, feel free
Yeah, I'll
to
let you
stop all
know.
of us
Yeah,
and just get into it.
yeah, sure. Yeah.
Right? So I see. I want this discussion to be this vibrant, okay? Where you are putting in your thoughts, I'm putting in my thoughts, so that all of us can learn from each other, right? So it should not be a one-way thing. And in any case, to Pradeep, anyone you feel that you are getting missed out, your queries are not being addressed, just stop me in and put in your queries, right? And obviously I'll take it up.
Sure, Tanmay. Thanks. Thanks.
Sure. Yeah. Great, guys.
My name is Ajay Housekeeping.
Yeah, so are we done for today?
Hey, hi. I'll just take it up for 5 more minutes, and then for today we will close because today is the first day of the discussion, right? The
Yeah.
next week or next class we'll take up full 3 hours of discussion, because today I just wanted to lay out the scope of the discussions. Okay, so okay, okay. So having said this, having laid out this framework, now let me just talk about some of the so the way the provisioning measures, or the provisioning models have evolved over time, right? So let me just give that background and close the discussion today, and then from there we will take it up in the next class. Okay, so over here, one important thing. So let's just try to figure out the way the evolution has been happening. The evolution of provisioning models. Of provisioning models. So over here, so the first and the most, the basic model of provisioning was the incurred loss model. was the incurred loss models of provision. So the first question that comes out over here is that what exactly is this incurred loss model? So when I talk about incurred loss models are models which provision after the event has actually occurred, and hence it is these models or this method of provisioning is very adaptive in nature. It's naive and adaptive in nature. So it's naive and adaptive. Now the question that comes out over here is that how does these models actually work? So what happened was, so these are the most conventional and these are the most classical or the traditional form of ever provisioning models. Now what happened in these models are, number one, as you start, so basically there was a borrower A who was given the loan. Borrower A is given the loan, right? Now borrower A starts repayment. He starts repayment, right? Okay. So after certain time, so he started paying and he paid the first two installments, right? He paid the first two installments. Then what happens is, then he loses his job. He loses his job. Now, the moment he loses his job, right? So this is called a credit deterioration event, or this is called the loss triggering event. This is an event of credit deterioration. Credit deterioration. So this is an event of credit deterioration, right? Or this is also known as the loss triggering event. This is called the loss triggering event. Now, when this event actually happens, so this is credit deterioration, there's a loss triggering event. Now, after this loss triggering event has happened, the next part is that he will take some time, right, to report the event. So he'll take some time to report the event. Now, once this happens, right, so what happens over here is the once the report is made, then once the report is made, then the next time what they try to do is, so yeah, so once the report is made, the loss is noted, right? So that's the occurrence date for the bank. Now observe that there is a lag between the fact that the loss triggering event has occurred and the event has been reported. So the occurrence date is always, or the bank's realization is always after a lag, right? So this lag makes it, so this lag over here, this makes it a naive process. So this makes it a naive process. Right? So, so over here, what we have is the loss occurrence, and hence this process was a naive process. So basically, when okay, so this makes the process a naive process, right? And hence the losses that you are provisioning for, you are provisioning once it has already incurred, right? Now this measure was, or this approach was there for a long period of time, but only after 2008 people realized that this kind of an incurred loss approach is actually suboptimal in approach, or this kind of incurred loss modeling is suboptimal, and hence losses needed to be forward looking in approach. And that is where the financial accounting standards regulation and the international accounting standards regulation started coming into play, right? So that is the part from where loss forecasting started becoming more and more predictive in nature. Expected loss estimation started becoming more and more predictive in nature, right? And that is precisely what our study would be. So in the next class onwards, we'll start off with the FASB regulation and the IFRS 9, regulation. We'll explore the differences that Financial Accounting Standards Board has or had as a, you know, as a regulatory body, the differences that it has from the International Accounting Standards Board, and how did these two separate groups of regulations come up one after the other. How did ALLL come in? How did IFRS 9 come in? And what are the key differences between these two approaches, right? So that is what we would be doing in the next class. So in this class, my objective was to set aside the scope, right? Set the scope of the IFRS 9 and the other regulations apart, and to introduce to you the concept of incurred losses, right? Now, after this, we'll start with the regulatory frameworks in detail, and as we go ahead, we'll take up each banking product one by one, and for them we'll see how IFRS 9 would have treated it, and how did FASB or Basel treats those assets. So one asset, we looked across multiple regulation and its respective treatments, right? So that's it. So I'll since it's the first session, I'll not be pounding in too much, and we'll pick up the pace from next session onwards. Thank you guys. That's much from my end. Please reach out to me with any queries you would have, any questions and queries. I would share over the recordings, and I would share over the documentation on the whiteboard that I have done today, both for the credit risk modeling sessions and for the IFRS 9 impairment model development validation sessions. Right? Thank you. Have a great week ahead, and we may meet next time.
Thank you,
Bye-bye.
Tanmay. Thanks. Thank you.
Bye-bye.
Thanks, everyone.
Thank you.